Hello and welcome. With Gardner Intelligence, I'm Michael Gukas, Chief Economist and Director of Analytics. It's my privilege to share with you in this video our review of manufacturing business activity during the early weeks of 2021, thanks to the feedback that we received from manufacturers across the United States. If you are one of those who gave us the privilege of your time by completing our January survey, please know that you have my deep thanks. Without your help, it would not be possible to produce reports like these. Lastly, I would like to remind you that Gardner Intelligence has far more information than I can provide to you in a short video. It would be our privilege to help your company build a data-centric strategy as you navigate through 2021. We would love to be able to help you make 2021 a great year for your company. You can reach us at our website, gardnerintelligence.com, or by using the contact information at the end of this presentation. Thank you.
The Gardner Business Index extended its accelerating growth trend with a 54.4 reading, bringing it to a multi-year high. As we dig below the surface of the top line number, however, we will see that the index is telling us a rather complicated story. Evaluating the independent readings of the 6 business components which constitute the GBI allows us to understand what drove January's manufacturing activity. At the top, we have supply chain readings. Higher readings correspond to longer order to delivery times for the upstream products needed by manufacturers to produce their own goods. Moving down, Gardner was greatly encouraged to see new orders and production rebound in the fourth quarter of 2020 and to continue that trend into the new year. As a leading indicator, the movement of new orders activity frequently drives the movement of other indicators. Expanding new orders activity, for example, often drives changes in unemployment, which we see in yellow and is following new orders and production's expansionary trends from earlier. At the bottom is exports in red, which continues to report contracting conditions. This is not surprising given that economic activity in much of the rest of the developed world continues to report far more difficult conditions. While the US reported a 3.6% decline in GDP in 2020, according to the latest data from the Economist Intelligence Unit, many other countries fared far worse. Among some of America's largest trading partners, we saw that Canada contracted by 5.2%, Mexico by 4.5%, Japan by 5.7%, and the Euro area by 5.1%. Here we have factored out the influence of disrupted supply chains and worsening order to fulfillment conditions, which has an inflationary impact on the GBI. Once this factor is removed, we see the orange line here, which at the end of January registered 52.0, signaling the modest expansion of the manufacturing sector. In recent months, we've been asking ourselves, is it the links or the nodes which are affecting our supplier delivery readings? The answer seems to be yes. During the fourth quarter, we put a considerable amount of weight on the links as the issue because of a surge in e-commerce shipping and COVID vaccine rollouts, which were putting incredible strains on logistics networks. Pinning our weight on these events, we anticipated that the supplier delivery reading would fall in the post-holiday period. That this hasn't happened in January may tell us a few things. Are we simply being impatient? We may need to wait another month or more, perhaps, to see some improvement in the links. Did we put too much emphasis on the links and not enough on the nodes? Capacity utilization figures in the truck and rail sector are not, at an aggregate level, above normal historic levels, suggesting that there are minimal bottlenecks in these links. Maybe we've been looking at the wrong data. Thirdly, did we just underestimate the influence of the nodes relative to the links? There's much anecdotal evidence that within facilities, there are difficulties with finding enough employees, keeping employees healthy, or other snags in getting products out the door. Many reports have surfaced of whole manufacturing lines shutting down for lack of a single subcomponent or raw material. It has been reported elsewhere that anything less than high volume commodities are becoming more difficult to acquire. Here I want to point out that historically, the Gardner Business Index has not seen expansionary backlog readings when new orders readings are this close to 50. Usually it takes very strong new orders readings to see a surge in backlogs. Since at least 2011, most new order readings below a reading of 55 have been associated with contracting backlog readings, in fact. That we are seeing expanding backlog activity in the face of relatively mild new orders activity now and virtually no spread between new orders and production activity seems to suggest that backlogs are being driven currently by supply chain activity rather than the long-held relationship linking new orders and production to backlogs. If this is an accurate assessment, then we may have to expect additional months or quarters of rising backlogs until supply chains can be more fully repaired. Lastly, I want to touch on the pricing and profit impacts being caused seemingly by snarled supply chains. In our prices received and material prices data, which I have charted here, we are seeing accelerating expansion in material prices at a level rarely experienced. Our orange line, which illustrates aggregate pricing power here, indicates that a small but growing proportion of manufacturing firms are already pushing price increases onto their customers. In a recent study by Gardner Intelligence, this pricing power data, when segmented by company size, has already begun to clearly show that larger firms represent a disproportionately large segment of the manufacturing community, which has already begun to increase prices on their customers. In contrast, smaller firms have either withheld price increases on their customers or have not been able to push them through. In our years of working with small firms, we have much anecdotal evidence to suggest that small firms tend to hold prices down too long during phase changes of the economic cycle, out of fear of losing business. For those small businesses out there watching this video, I hope that you can take advantage of this information and use it to optimize your own pricing. All right, so what does this all mean for us in 2021? Let's first remember that current conditions are already highly volatile by industry. The industries in which you are operating in are almost more important than any other aspect of your business or the economy right now. Manufacturing has done relatively well this far in the economic cycle. In fact, many economic indicators are revealing a more rapid economic recovery in the US than many expected just 3 or 6 months ago. Among publicly traded companies on the S&P 500, half have already reported their fourth quarter 2020 results as of the time of this recording, and 83% of them beat their earnings estimates with an average beat of 17%. A lot of these beats, a lot of these numbers are record-setting. Thus, the first insight is that if the domestic economy continues to perform better than expected in 2021, are there things you should be doing now to hedge your company towards a better than expected year? What investments or changes might you need to make or want to make in capital spending, hiring, and supply chain management, which will help improve your sales volumes and profitability in a year that might be better than many are expected to have? If supply chain problems spill over into lengthening backlogs, what can you do now to prepare for this? Are there adjustments to your shop space, processes, or contracts that will help your firm manage the potential for rising backlogs? So that's it for this month. Thank you for the privilege of your time. If you have questions about what you have seen here or want to learn more about how our business index data can help your firm be better prepared for the future, we would like to hear from you. You may reach out to me directly or to the Gardner Intelligence team through our contact page at gardnerintelligence.com. To those of you who take the time to complete the GBI survey sent to thousands of manufacturers each month, we offer you our sincere thanks. Only through your participation are we able to assess the current state of the industry and where it may be heading. We hope that you will continue to support this work by filling out those surveys. Thank you.